All right, let me share my screen. Bam. Oops. All right, Mokama, Sunday service. Today we are going to be talking about how to build a stock market watch list. Just from the practical on Thinkorswim, and just like what are some of the things that I'm looking for to be on my watch list for something that might trigger soon rather than something that's far away from where I want it. Uh, for people out there on YouTube, this is for informational purposes only. Trading and investing are risky activities. Refer all of your trades and investing to your licensed financial professionals and do your independent research. So, with that said, let me. Can you guys see my screen?
Yeah.
All right, let me. Should I? Okay, yeah, let me share Thinkorswim first. All right, so if you're in your Thinkorswim platform and you essentially log in, it's going to look like I'm on charts right now. I'm not going to go to the home page, but it's going to look something like this. For me, my watch lists are extremely important for a couple of different reasons. The typical watch lists that I always have up are going to be these three. I like to watch the indexes, or essentially the futures. I watch the indexes through the futures. As I explained last week, the four major pillars of the stock market, like if you were thinking of it as like an engine and it's a four-cylinder engine, it's going to be the Dow, which is backslash or forward slash YM. It's going to be the Russell, which is the small caps. It's going to be the S&P 500, which is forward slash ES, and the NASDAQ, which is forward slash NQ. And this is where most of the tech stocks are, right, or the tech sector. So when I'm just looking in the morning before I start trading, usually the first hour of the day, even if I'm swing trading, middle of the day or something, clips a level where I want to catch something at. I'm going to be looking at my indexes and my futures to figure out what the general market is doing, right? So I know I have some other symbols up here too. This is natural gas, NG. This is crude oil, CL. ZB are the bonds. HG is copper. GC is gold. And the last one is the VIX. This is the one I have up there to see like how much or what the volatility looks like for that day. So like if the volatility is crazy, that means I'm probably going to shorten my size for the day or have shorter targets. Like it's been doing the last week or so. It's been a crazy volatile market. So I've had like some shorter targets, some stop losses that are a little bit tighter because of that. But essentially, I'm looking at a general watch list of what the market looks like to tell me what direction I'm going in for that particular day, and or like what direction the market looks like, so if I see the Dow down and I see the Russell down and I see the S&P 500 and the Nasdaq up, we kind of have a mixed market. It might be choppy that day, right? There's not like a lot of true direction of like what we're doing that day, versus if I see all four of these, the NAS, the ES, the Dow, and the Russell up, it's probably going to be more of a positive day where that's where the momentum is going to be. So for day trade wise, I'm waiting for a pullback on one of those names and then taking it to the upside because the whole market is up. On on In contrast, if all four of these are down, then I'm looking for a downside trade that day. I'm probably going to be buying puts or selling call spreads that particular day, or shorting shares. I don't really short shares. I usually buy puts or I'm selling call spreads. But that's what I'm looking for that day. So I always have a watch list up. If you look at this menu area right here, if this is something else, you could switch to gadget and go here and go to watch list. And if you don't have a watch list built, I would say just copy mine. If you copy all of the names here that I just gave you, that's going to be a good watch list to make an index watch list, right? So if you switch gadget, go to watch list. If you want to make a new watch list, you click on the area to the left of this menu button, and then click create watch list. And then when you click create watch list, you can name it indexes. Can you guys see my Thinkorswim application?
Yeah, I see it.
You see this
Yeah,
new watch list box too?
yeah.
Okay. Right. So name it whatever you want to name it, and then you can just start putting in symbols. So if I wanted to put in the Dow, if I wanted to put in the S&P 500, the futures, if I wanted to put in the Nasdaq, right, and if I wanted to put in RTY, right. So that's how you essentially make a watch list, and we're talking about like specifically. Now, the second half of this is going to be what should be on your watch list in terms of stocks, but generally, I'm always going to be watching these four, paying close attention. The reason why I watch the futures is because they're open pretty much 23 hours a day. So if even on Sunday night you're trying to figure out what the market's going to look like tomorrow, you can go look at what the futures are doing right now, because you could trade these almost, 23 hours a day. So I'm not going to save this because I already have my watch list there, right? And in order to go find that, you would come down here, go to personal, and then all of the ones that you've created will be here, right? So that's how you make a watch list. So typically I have three up. I have the index futures watch list. I have an ETF watch list because this is like, I would say, how I've explained it before, like this is the ocean, right? In terms of the four main cylinders. And like the ETFs are like the tides inside of the ocean, and your stocks are like boats inside of the ocean, right? So I'm keeping track of the oceans, like in ocean currents, and I'm keeping track of like the tides um, inside, like the push and pull from different sectors, so I can go figure out what same thing. It's like what's strong that day, what's weak, what's pulling back, what's not. So these are from Friday. So if I just take a quick look without me having to go look at a million different stocks, I know communications were up on Friday. So I just understand communication stocks and I know what's in them. That means Meta and Google were probably up because those are the two heaviest weighted in communications, right? So if you look at Meta's, let's go to a day chart. Meta was up on Friday. Makes sense. Google was up on Friday. Makes sense. That's why XLC was up. And then what's another? Netflix is decently weighted in there. And Netflix was up on Friday, which makes sense that XLC was one of the top performing ETFs because the three heaviest weighted names were up on Friday. So we got XLC up. So if this was Friday and I'm looking at this in the morning, then how I'm going to day trade, at least how I particularly trade, I'm going to be looking for. It was up slightly up on Friday, right? Apple looked stronger. So chances are Friday, if I were day trading this, I would have been waiting on a 5-minute chart, waiting for a pullback on Apple because it looked strong, the sector looked strong. Healthcare, same thing. I think healthcare had some earnings though last week, but just say it didn't have earnings. XLV was up. So I know Lilly is big in XLV, up that day. Johnson and Johnson up slightly. right? UNH. Oh, UNH is actually down. Random. So I wouldn't have taken that name. Um, but you guys feel me when I say like what I'm doing when I'm like searching, like, hey, what's hot? So for a daily watch list, if I'm day trading, right? If I'm just trading options, if I'm scalping, I'm looking for what's hot. So if I'm creating my watch list for that day, I'm going to be looking at the sectors that are currently up and figuring out what's inside of those sectors. If I can't take the sector itself, I'm going to be looking at what's inside of those sectors and what's hot. Because if the whole sector is up, if healthcare is up, then chances are a trade on Johnson and Johnson or Eli Lilly is more likely to work because the whole sector is up. And then I also know that this sector, healthcare, is big in the Dow. So if the Dow is up, I'm going to feel more confident that this sector is going to keep going up, right? And then if the Dow is up and the sector is up, I'm going to feel more comfortable that Eli Lilly is going to go up that day. Just from a trading standpoint, where like the probability of my trade is more likely to work if I have the Dow up and healthcare up, then chances are Eli Lilly or Johnson and Johnson are gonna do better that day, right? You guys feel me what I'm saying about that?
Yes, sir.
All right, so that's why having these watch lists up consistently kind of give me like some trade confirmation. Same thing, like let's say if I'm let's go to the NAS. Let's say I'm day trading Apple and I see that NQ it's up right now. Let's say I see NQ is down but starts bouncing. Like if I see NQ is down like here and starts bouncing up, then chances are if Apple was down, then it's probably going to start bouncing around the same time. So just from like a timing of a trade too, like what I like to see happen if I'm trading a tech stock, I want to see NQ going up at the same time. If I see, because that's the whole sector, the NASDAQ, all of the tech. So if all of tech is up, I'm going to feel more confident. Like if I had a pullback on Apple, let's say on this day here, and I see all of tech is starting to rise. Let's say if NQ is at like flat for the day, and then I see it go up 0.1%, 0.2%, 0.3%. I'm going to feel more confident that Apple is going to start rising too because the entire tech sector is going up. So this is another reason why I have these here. I always want to, and then I know a lot of people like I trade off of one screen. I really need to start trading off two or three screens so that you could easily see like two or three things happening at one time. But like if you're looking at a sector and the sector's bouncing and a stock within that sector is low and you have a feeling that that's going to start bouncing too because it's tied to that sector, if you're looking at the chart, the charts are moving the same, you're going to feel more confident taking that Apple or Microsoft trade if the Qs are bouncing and the Nasdaq are bouncing at the same time, you so that's the importance of a watch list. So now when we're talking about how do I determine what's going to be on my watch list, right? From a long term standpoint, that question is going to be different versus day trading. So, from a day trading perspective, I'm looking at what's trending and what has momentum for the day, either to the upside or to the downside. So, if we're looking at these from Friday, I just showed you the day trades that I would have been looking at from the upside if these numbers look at like 6:15, 6:20 in the morning PST, 9:15, 9:30 Eastern time. If this is what my stock market looks like on Monday, right? And I see XLC is up. I don't really like trading XBI because it's equally weighted things inside of that ETF. So Like it's harder to kind of day trade names inside of those. There's a lot of smaller names inside of those, but QQQ and XLV or XLK, those are going to be the things that I'm going to be targeting if this is what my market looks like on Monday. So my watch list for that day would be Google, Meta, Apple, Microsoft, Nvidia, Eli Lilly, J&J, and that's pretty much it. That would be my watch list to the upside. To the downside, um, would be KRE, IWM, and chips were kind of neutral, so I probably wouldn't do chips to the downside, but it would be KRE, which are the regional banks, right? That was down on Friday, and Russell pretty much RTY, which is IWM. I really wouldn't trade anything other. I wouldn't trade anything inside the IWM. I would trade the IWM itself, which is like a proxy for the Russell, which are the small caps. But that's what I would be shorting. But that's how I would determine my watch list for that particular day. So if this is what the market looks like, if it was a snapshot, everything is still right now. But if this is what the market looked like on Monday morning, I would be looking at those specific names for that day for a day trade. Right, if it's to the upside or KRE and IWM to the downside. Probably one or the other because these two names are pretty much linked. KRE is a big component of the IWM. So really, I'm just looking to short the Russell, looking at what this looks like right now, and I'm looking to go long Meta, Google, Apple, Microsoft, Nvidia, maybe Amazon. Amazon's been doing some weird stuff lately though. Right, so that's a daily watch list. From a long term watch list, I build my watch list a little bit differently, and I've shown you guys this before. For my long term watch list, I'm not just looking at technicals. So from a daily watch list, I'm just looking at prices for the day, pretty much. What is the market doing for the day? I don't care what the earnings look like. I don't care what the margins look like. I just hope I'm not day trading anything usually that's getting ready to report earnings. I will get out of that trade if it's a day trade before the earnings occur. Wait a couple of days for earnings to settle down before I trade a name that just reported earnings. But if I'm looking long term, I'm looking at more than the technicals. In fact, I don't start with the technicals, I start with the fundamentals. So, my boy Ange, who's not on the call right now, he was like, well, can you go through the process of like what you'd be looking for in terms of a long term trade? And like, this is how I would build my watch list. I'm looking at ELF right now. You guys have seen me mention this before. The reason why I like ELF is because look at what they just reported. They reported last week, 3 days ago. Their expected earnings per share was 89 cents. It was $1.10, right? The expected revenue was 306 million. It was 324 million. This is a makeup company. I don't wear makeup, but like, I know other people do. My wife said she's been seeing this company a lot in all of the stores. So for me, like, I don't wear makeup, but the people that do wear makeup know about this company. But look at the revenue growth. Reported better than expected, right? 6% better, 23% better on the earnings per share. But let's go look at what the stock did. Stock tanked after the earnings. You see that?
Yeah.
I like divergence like that. The earnings were good, but the price came down. Though that's what I'm looking for in terms of a buy. Fundamentally, this looks like a good company. It's reporting earnings that beat expectations. The earnings per share beat expectations. That people, it went down because they want to spend more money on marketing and advertising. But that's what I'm looking for. Like, look at the high. It's down from its high, and the earnings weren't terrible at all. In fact, they were good. So a company that went down on good earnings, that's the type of company that I'm looking for because I'm like, wait, this might be a diamond in the rough, right? People are selling this thing, but I just showed you its earnings, right? So I'm okay. I'm like, okay, great. So I I'm always looking long term for a good stock that's pulled back, that is discounted. So if we're saying that 221 it was its high, it's now at 160. So if we use this calculator over here, 160 divided by 221, this thing is almost 30% off, right? It's almost 30% off. I would love it if it got down to 140. As you see, I have an alert here at 141. Tell me if it gets down here. That's my price that I really want to buy ELF at, right? And then it'll be even more, it'll probably be like what, 40, almost 40% off at that time, right? So and it's right at a fib level. So I tend to like to catch the stocks that I buy long term either at a moving average or at a decent fib level. So this is a good fib level right here. So I like it if it gets to $140, even 141. I might take a stab at it, right, on ELF. And then let me just go back to its actual earnings report, right? So from a fundamental standpoint, still, if you look at the net sales from last quarter of 2023, of the quarter two of 2023 versus this quarter, look at the growth. So it went from 216 million to 324 million, right? The gross profit went up. The one thing is the operating income because it looks like they spent a lot more either on marketing or paying employees right there, right? So this number went up, but I like it in terms of like just the growth in sales, like going from 216 million in sales to 324 million. And then the TAM on beauty products is so huge. I could easily see this being $1 billion company in the future. So getting the growth from that in the stock price, because this could triple over the next few years in the beauty products, I don't see that it would be really difficult for them to go from 216 million to $1 billion in sales. So this is still a smaller company, but I like the fact it's profitable. It actually makes money. The profit went down, which is probably another reason why the stock price went down, but it's growing. I love a company like this that's growing, that I'm starting to see everywhere, and is discounted currently. So, yes, if we can get back to 140, 141, I'm a buyer on ELF, right? So, that's what I'm looking at. Then he also wanted me to like, how would I buy ELF? Well, first, from a long term standpoint, if this were going in my long term portfolio, not swinging it or day trading it, I usually like to look at leaps first because I can get more alpha on my leaps, get more leverage on my leaps than buying shares, right? So, on my cash specifically, we're in August, so if I go a year out, I'm looking to see if there's any open interest and calls, and I see nothing. I'm seeing a bunch of zeros. That looks terrible, right? Let's see. We have anything in June even? No, that looks terrible. Absolutely terrible. In terms of the open interest on these contracts, so I would not buy leaps on ELF. What I would end up doing is I would just buy the shares. So if it got down to around 140, I would try to probably pick up probably a little less than 100 shares of ELF, right? Hoping that this goes back up to 221. And if I get it at 140, I got it at a significant of 40% discount, then that would be great, right? So then, like if it drops a little further, you could stomach it a little bit better. But if you're looking at this, even on a weekly chart, looking at that 50-month moving average, ELF hasn't really dropped much below that since then. So even grabbing ELF at like 150 wouldn't be crazy, But I would love it if it got down to 140. but it's been holding that 50-week moving average for a long time and then rebounding from there. So Elf, that's one. All right, let me. What's the second one? Amazon. So this is a big Magnificent Seven stock, right? We look at its most recent earnings. It missed on revenue expectations anyway. The market was expecting 148.7 billion, and oh my God, it only reported 148 billion. Oh my God, Amazon is falling, right? Crazy. The fact that it makes 148 billion dollars a quarter, right? A quarter. This is a third of the year, or I mean a fourth of the year. It makes 148 billion dollars in a fourth of the year, but then the earnings per share went up, which means it's probably increasing margins or whatnot, right? So that was a really decent surprise. It's 23%. Once again, let's go look at the stock price. AMC, yeah. And what did it do after reporting earnings? It dipped, right? Look at that massive fall. So once again, I love divergence. Amazon is not a bad company. It missed on earnings expectations by a little bit and had this massive correction, even though it was already correcting. So let's same thing. Let's go look at where it currently is. It's 166. I want it, if you look at my alert, if we get back down here to this fib level again, to where it's almost 40% off. If it gets back down to, what is that, 155.40, so like maybe 156, 157. So if we take 156 divided by 201, the high, 201.20, that would be about what? 23% off? No, where am I tripping? That should be. Why I feel like that's off? Hold on, let me do that again. 156 divided by, let's just do 201. No. So that is what? 23% off? Why do I feel like this should. Oh, you know what? The fib levels are a little. So that's 23% off is high. That's a pretty good correction. Anything over 20% for me is like a good correction, right? So from 201 down to 156, that's a 23% correction off the all time high. Off a stock like Amazon is not going to go out of business anytime soon if it makes $168 billion a quarter, right? So look, if you look specifically though at the numbers, I like going directly into the financials, like and looking at the different segments. Where was Here we go. So I love how they break it down here, and you can kind of see like how it's making us money. So quarter two of last year made 52.9 billion on the online stores, and look at the growth still. It made 55 billion this quarter. Physical stores 5 billion, 5.2 this quarter. Um, Third party seller services, so like Amazon fulfillment stuff, 32.3 billion last quarter, 36.2 this quarter. Advertising revenue, so if you see those sponsored ads on your Amazon shopping page, 10.6 billion last quarter, 12.7 billion this quarter, right? Subscription services, so paying for Amazon Prime, 9.8 billion to 10.8 billion. AWS, the cloud, which is its crown jewel, 22.1 billion, still growing, 26.2 billion, right? And then other, I don't even know what's in there. But if you look at the revenue from last quarter, it was 134.3 billion. Now it's 147.9 billion, right? Amazon is a good company that is still, if you don't look at their balance sheet, now you might say, well, it's growing a little slower, but like, so grabbing this on a 20% pullback, my thing is, do the reported financials justify a 20% pullback or 22% pullback? Me looking at the fundamentals, I don't think it does. So this is a company that's on my radar to buy because I think it's really discounted right now in terms of the technicals on the stock. But if you look at the sales, look at the sales. Like they're all going up in North America, internationally, AWS. And this is what I love about AWS. Look at the difference. So they made another $4 billion. They went from 22.1 billion to 26.2 billion, and the operating expenses only went up by like $200,000 or something. Or maybe that's 200 million, right? But there's no significant increase in the operating expenses. You see that, DeAndre?
I do see that,
That's
and
great.
that's great.
That's crazy to me, right? How do you make an extra $4 billion without spending much more to do it,
Hmm.
right?
Essentially earning money at this point.
Exactly. So like that's crazy that like you can get your operating income to increase like almost double by not even doubling your sales. But they got their operating income on AWS to almost double without like doubling the sales. That's crazy to me. So for me, like I'm still bullish on AWS on the cloud. Um, I was at Essence Fest a few weeks ago, and we went to this panel. It was like a biotech. Sorry, it was like a biotech entrepreneur panel, and the guy that was doing this, that had this AI company. I was asking him, how are they running their language models, and he said they were using AWS to run their language models. So it's like AWS is kind of like the picks and shovels for everyone who's trying to create AI technology. They're running it off of AWS or Azure or something like that, but AWS is in the lead. So like this is everyone is using AWS for their cloud infrastructure. Even like you'd be surprised, a lot of these cloud-based companies like Dropbox and whatnot, they're running their servers off of AWS or Azure or something like that. So love this segment, and I just love the fact that they can create that much alpha off of and get that much alpha without spending much of anything else to like increase the infrastructure to get these types of sales. That's yeah. So I'm blown away by that. So if that's why I like Amazon, right? Amazon is consistently growing. Can we go see how much cash? I know they probably have a ton of cash on hand. $71 billion of cash just sitting, you know, on the sideline. So even if we get into interest rates seem to be the market thinks that interest rates are coming down, so they're going to benefit from that. And even if we did go into a recession, they got $71 billion just sitting on the sideline, you know. So they can buy companies, they can increase investments, they could potentially issue a dividend. Amazon historically doesn't like to do that because it wants to invest in its growth. But if they started passing out dividends to shareholders, stock price is going to go up. So yeah, I like Amazon long term, and I just like where the stock price is in comparison to what the earnings look like, right? So I like that long term, especially if it can come back down to that price at 150, 650, 155 to 157 is where I would try to buy it. How would I try to buy it? Same thing. Look at the leaps, try to look at like at least a year out, see if there's any open interest. I see none, which is crazy because this is Amazon. I do see some in this September 19th leap right here. Bam. There's my target. I would buy a leap. That's how I would buy Amazon. So, why would I buy this leap? And you see the difference between Elf's option chart far out and Amazon? You guys see that difference?
Yeah.
Look at the open interest. So this is going to be highly liquid, even a year and a quarter out. You got a highly liquid option, which means it's going to be easier for me to get in and get out of this trade. So that's generally what I'm looking at for any option I get in, whether it's short term or long term. But this makes me feel better that there's 4,000 people here willing to buy and sell this option, which means that other people are looking at this as well. So that's the leap that I would buy. And why would I buy the leap? Yeah, you're like, wow, these are expensive. That's $9,340 to buy a leap. Yes, but that's for a contract for 100 shares. If I were to buy 100 shares of Amazon, that's $16,000 right now. You see that?
Yeah.
So I can grab two contracts of these for approximately a little bit more than the same price as that. So I can get more leverage on my money. And then I want to go in the money, deep in the money, where the delta is so high, it's 98, that it's going to move almost exactly with the stock price. So I like that. And there's very little time decay because of how far we are in the future and because of how deep in the money we are. There's going to be very little time decay on this option. So that's why I would take Amazon conversely. I would take the September 19th leap. I would try to buy it as close to the bid as possible. These are off because the market is closed, but the last price, which is this column right here, is going to be what that option traded for most recently. It's usually never below the bid price, which is why I know it's off because the market is down right now. We're in aftermarket hours, but generally that last price is not going to be lower than 91.50, right? Which is why I know this is off. So I'm usually trying to get in as close to the bid as possible. So instead of paying $9,340 for this option, I'm going to be trying to get this for 9,150, right? If I were to buy it at where the price is right now, rather than if it dropped down to like 156, which is where I really want to get it, right? Does that make sense in terms of like how I would buy this? And then I would take two contracts of this. So if we're talking about execution specifically, I would click on the option. And if I were trying to get it at 91.50, if I saw that the last price it was trading at was 91.50, I would put that in my price, 91.50, right? And then I would buy two of these. Just knowing me, I would buy two of these so that I could scale out of one potentially at one target and then keep a runner for a second target. But that's how, and then I would confirm, send, enter, but I would be trying to put a limited order in at the closer to the bid so I could get a discount on this rather than buying it for the highest price. If I paid 9,340 for this, I could get in right away. But that's the most expensive price for this option. My goal is to get it for as close to this price as possible. And or where the last traded price was if I want to get in quickly, you know. So yeah, that's my Amazon my Amazon analysis. I love Amazon if it gets back down here and looking at the liquidity of the leaps, and which is a year and a quarter, or no, actually almost a year because we're in August. A year out, I would love that Amazon leap with the 80 strike price because the open interest was so liquid that I rarely see that in leaps. As you saw in Elf's leaps, there were zero people there. Here in Amazon, like, and the fact that you see a bunch of people hiding out there tells me that that's probably a good area to buy, you know. All right, and then let's go to the last one. I wanted to show you Airbnb because I'm not so keen on Airbnb anymore. Um, just because its earnings reports have been kind of all over the place. It did beat on the revenue, but the earnings per share is down. A lot of people communities are becoming anti Airbnb. They're putting up more restrictions for people to Airbnb their property. So This is why I'm like, I'm kind of iffy on this one. It would have to drop a little bit further before I would be interested. But if you're looking at their quarterly revenue, um, it's going up, but it's not like rising, like it's not growing as fast as it used to, you know. But it's going up. The North America revenue went up by what point, like 200 million, no, 100 million. Europe, Middle East, and Africa by what, 100 million, a little less than maybe 50 million. You know, smaller gains. Uh, so yeah, it didn't blow it away. And if you look at its stock price, Airbnb, right? You look at the stock price. I don't. The chart doesn't look as good as like when we looked at Amazon, right? Amazon, we see this dip, but look at that bullishness of the chart. Airbnb looks similar, but it never really got back up to its all-time highs. So technically, I don't like this. It is severely discounted though. If you look at the RSI and how oversold it was, like it's hard to get a stock more discounted than this. And I would say this 115 area is a really good level. So if you were to buy it, but I would swing this more than I would put this in my long-term account just because I'm not a big long term believer. And this is somebody, I have a property on Airbnb right now as a midterm rental, but from a long term standpoint, I just know there's so much there's a bunch of regulatory hurdles for this company. If there was no regulation anywhere, I would say yes, this thing is going to the moon, right? But everyone is imposing regulations. They're striking and what was it, in Europe and Spain? I think it was in Barcelona. They said there were too many tourists. The price of housing is going up because everybody is turning their house into an Airbnb rather than renting it to people who actually live there. So I just see a lot of political pushback on Airbnb, at least in the near future. So it's going to stop it from getting back to its all time highs. But I do like it right now for a potential swing, maybe back up to 134 and then cutting it. But I don't really like this so much for my long term portfolio unless maybe it gets back down to that all time low, or not all time low, but the 5 year low of 81 bucks, 82 bucks. If it gets back there, yeah, I think it would be worth it. It would be more of a value stock at that point, and then maybe trying to swing it back up to where it was again. But from a long term standpoint, I don't like this as much as I like Elf. If you look at the Elf chart. Look at Elf's chart. Look at Amazon's chart, right? Long term. Amazon's a little bit more wiki, right? But look at that recent uptrend versus Airbnb. Look at these highs 5 years ago, and it's been kind of constantly coming down. So I don't like Airbnb as much as I like Amazon and the others. And if I were to look at Airbnb, let's say you did like Airbnb for a long term trade, once again, I would go look at the leaps. And here, I still don't see any liquidity in a leap that's deeper in the money, which is how I like to buy my leaps. I don't see a bunch of liquidity. Oh, and that's 2024. Hold up. Well, let me go out to 2025. I'm looking at the wrong one. We're looking at June, not a lot of liquidity. Even let's go to January, not a lot of liquidity there either. So if I were to buy this, I'd buy it with shares if I'm going long term in terms of investment. But if I'm going to swing it, I'd be swinging it with like some options. But I don't even see any liquidity inside the options either, actually. Let's see if there's something closer. No. Maybe for this week. That's the only liquidity I'm seeing is for this actual week. So for that reason, I probably would stay away from Airbnb. Um, Maybe, yeah, a short term swing that would expire at the end of the week, but that's about it. Okay, let me go back since I went over those three stocks that I've been looking at. Let's look at the sectors. So, from a day trading standpoint, this is always what I'm looking at now. Koifin, free tool. There's a paid version of it where you can upgrade, of course. I don't represent them or anything, but it is a good tool, even the free tool. I'm always pulling up my sectors to figure out what I'm looking to day trade or swing that week. What I'm looking for are what's been strong. So regional banks have been strong over the last month. XLU, I'm currently in an XLU trade right now with some call options. XLV healthcare, Staples. I'm currently in an XLP swing trade right now with some call options. XLI industrials, XLF the financials or banks, big banks, and materials kind of sorta, but it's been mostly neutral. And then what's been weak? It's been the semiconductors, the chips, tech, and I think this is what is this? Consumer discretionary, which is mostly Amazon and Tesla, right? Um, and that's why I like some of these right now to buy long term is because they've had severe pullbacks. But for day trades and to the upside, I'm looking at the KRE next week. I'm looking at XLU next week, and I'm looking at healthcare next week, and I'm looking at the staples next week and what's inside of those. So I know inside of the staples, we went over this last week. You got stocks like Procter and Gamble, you got Coca-Cola, you got Pepsi in there, Colgate, Walmart, Costco. I wouldn't touch Walmart though because it has earnings on Wednesday or Thursday. I wouldn't touch it at least until I might swing it all the way up until it reports, but I would cut it before it reports. But that's what you got in XLP. In XLV, we kind of went over that. J&J, Eli Lilly, XLU. I think it's any. Is it NEM? Maybe that's another. I could be wrong on that. XLU. I think. Oh, NEE. I think it's the one stock inside XLU, but I usually trade the ETF itself. And then you have KRE. I usually trade the ETF itself on that too. So if we're looking at what's happening next week, Walmart has earnings on Thursday. Other than that, like most of the bigger companies, Home Depot on Tuesday, so I would stay away from that. But most of the bigger companies have reported. But when we're looking sector wise from a day trade standpoint, like that's what I'm looking at. I'm looking at KRE. And if you go look at the chart, KRE has been up. So like if we have a pullback on KRE, and I'll go pull up the chart that has my tools on it. So specifically looking at where these price movement ranges are, yeah, if I get something back at like 52 in KRE, I'm probably going to want to enter a swing. I would even love it if it got down to like 51.50 would be even better. So we're looking at XLU. And this is just for Monday. XLU, I'm looking at this level right here. 72.50 for a trade, a swing to get back up to like 73, 74, at least for an initial target. Like, so yeah, around 72.50 on XLU. What were the other ones? The XLP. I'm already in XLP, I think. Yeah. I'm already in XLP. I'm only up, what, 128 bucks on it. But I'm already in this trade, so I probably won't hop into XLP again. But if we're looking at what's inside of XLP, Procter and Gamble, right, has been stronger. Just this is the day chart over here. Procter and Gamble. I'm in Coke once again. But if Coke got back down to like 68 bucks to 67.50, that would be a good entry on Coke. Colgate. Probably if it got down to like 101 bucks, I would like Colgate on a pullback. And then what else did we say? Healthcare, XLV itself looks decent. If it got back down maybe to like 148.30, and then the names inside, like see how those look. J&J, if it got back down to 158, and then Lilly, which is typically expensive. I don't know if I would F with Lilly, to be honest. It's not in trend. But yeah, J&J would be my target. Not too keen on Pfizer because I had a bad trade on that last week. Not bad, I just lost. But J&J looks the strongest in the XLV sector. So those are the names that I'd be looking to go long on next week. And the reason why I'm still focusing on going long rather than shorting things is because if we go look at the general market, we are still in a bull market. Look at the NASDAQ. We are still well above. This is the month. Not well above. We're still above the 200. Bounced off the 200-day moving average. Went a little bit below. But we don't have any of these shorter averages getting near this 200. So we're still in bullish territory. S&P 500. Same thing. Still in bullish territory. We're above the 200. None of these are crossing below the 200. Dow, still in bullish territory, still above the 200. None of these are crossing below. And the Russell is in the worst shape of all of them, but still in a bull market. So I'm still looking mostly at things that are likely to go up rather than go down, even though we have some sectors in the tech sector that are down right now. I'm still more likely to go long than the short things at the moment. Okay. Any questions,
Nice.
Spence? We're here at 9 o'clock.
No, that was good. Good game. Good game.
All right.
Yeah. Good information as always, my guy.
Yeah, for sure. All right, that's it. Mokama Sunday service. Till next time, 8 a.m. every Sunday. If you want to join the actual Zoom and ask direct questions, please leave a comment on one of these videos and I will get you the information. And yeah, see y'all next week. Mokamas making it rain without the umbrellas.
Appreciate you.
Yep, deuces.
All right.
All right, peace.
Recording stopped.